While the dollar was boosted by the Federal Open Market Committee minutes last week, most other major currencies are having their own problem. Sterling was the weakest as pressured by the dovish Bank of England minutes as well as persistent chatter on the rating downgrade. Indeed, Moody's did downgrade UK's AAA debt rating to AA1 towards the end of the week, and that should extend the plunge in the pound. The euro was weighed down by a couple of factors, including uncertainties over Italy's election, weak economic data as well as disappointing long-term refinancing operation repayment results. The Canadian dollar dropped sharply as weak economic data reinforced the case that there will be no policy stimulus removable anytime soon. The New Zealand dollar was pressured by the Reserve Bank of New Zealand's comments on intervention. Also, one important thing to note is that the Japanese yen was firm as partly helped by cross-selling in the yen crosses. More importantly, the failure to ride on the G20 meeting to extend its downtrend argues then the yen has bottomed out at least in the near term. The dollar was boosted by the Federal Open Market Committee meeting minutes last week. The minutes for the January meeting indicated that policymakers were more upbeat on the U.S. economic outlook as driven by improved business confidence and household consumption. Discussions on continuation of the asset purchase program remained hot. Several participants suggested that the central bank should be prepared to vary the pace of asset purchases, either in response to changes in the economic outlook or as its evaluation of the efficacy and costs of such purchases evolved. A number of participants stated that the program should be tapered or ended before occurrence of a substantial improvement in the outlook for the labor market in accordance with cost-benefit assessment. Yet several members warned of the potential costs of terminating and decreasing asset purchases too soon, while a few participants cited past experience of negative impacts on economic growth, employment, and price stability of the premature ending of accommodative measures. Besides this, there were opinions that the Fed might provide monetary accommodation by holding securities for a longer period than envisioned in the committee's exit principles, either as a supplement to, or a replacement for, asset purchases. The euro was weighed down by a couple of factors. Italy's parliamentary election on February 24 to 26 was a major factor. Democratic Party's Bersani is still the front-runner, but polls have been showing that former Prime Minister Berlusconi's People of Freedom Party continues to close the gap. Markets are expecting to see Bersani winning a majority in the lower house and form a coalition with outgoing Prime Minister Monti in the upper house. However, markets are also complacent on the risk that scandal-mired Berlusconi might return to power. The European Central Bank said that 356 banks will pay back €61.1 billion on February 27 as early repayment of the second three-year long-term refinancing operation. That's way short of market expectations of $122.5 billion. Analysts said that would be a sign that banks are not finding enough demand for credit inside the Eurozone, which indirectly indicates weak growth momentum. While German ZEW and IFO were solid, Eurozone purchasing managers' indexes triggered much concern of a deepened recession in Q1. Manufacturing PMI dropped slightly to 47.8 versus expectation of a rise to 48.4. Services PMI unexpectedly dropped to 47.3 versus expectation of a rise to 49, hitting a three-month low. The composite PMI dropped to a two-month low of 47.3. Germany's data was mixed, with manufacturing PMI rising slightly more than expected to 50.1, but services PMI dropped more than expected to 54.1. However, France's data was worrying. While manufacturing PMI rose to 43.6, it missed expectation of 43.9. Services PMI even dropped to 42.7 unexpectedly versus expectation of a rise to 44.5. Market chief economist Chris Williamson noted that a steepening rate of decline in February is a disappointment, and suggests that the Eurozone is on course to contract for a fourth consecutive quarter. And, if it wasn't for Germany, these would be really dire readings. Also, He said that the latest survey suggested that the Eurozone economy would shrink 0.2% to 0.3% in Q1. European Commission revised GDP forecast to a 0.3% contraction in 2013, down from a prior projection of a 0.1% growth. Unemployment is expected to jump further up to 12.2%, revised up from prior projection of 11.8%. The European Commission warned that the job market is a serious concern and the social consequences will also weigh on growth perspectives. Domestic demand is not expected to improve until 2013. 7 states are expected to contract this year, including the Netherlands, Italy, Spain, Portugal, Greece, Cyprus and Slovenia. The Bank of England minutes unveiled that Governor Mervyn King, Paul Fisher and David Miles favoured adding more stimuli to boost the economy, but their proposal was rejected by 6 other members. The pound weakened further while UK stocks and gilts rebounded after the report amid expectations of more easing measures later in the year. Meanwhile, the central bank indicated the possibility of using measures other than asset purchases to boost the fragile economy in the future. Moody's downgraded the UK's debt rating from AAA to AA1 and changed the outlook to stable. Moody said that economic growth in the UK will be subdued because of weak global activities, as well as a drag from the ongoing domestic public and private sector deleveraging process. It noted that the period of sluggish growth poses challenges to the government's fiscal consolidation program, which we now assume will extend well into the next parliament. Also, the rising debt burden meant a deterioration in the shock absorption capacity of the government's balance sheet, which is unlikely to reverse before 2016. Chancellor of the Exchequer Osborne responded in a statement that, "We have a stark reminder of the debt problems facing our country and the clearest possible warning to anyone who thinks we can run away from dealing with those problems." The yen recovered on news that Japan would not buy foreign bonds. Also, traders took profits on their short positions as they are awaiting the nomination of the next Bank of Japan governor. So far, Prime Minister Abe has kept his mouth shut on whether former Deputy Bank of Japan Governor Muto or Iwata would be nominated as the next central bank governor, and markets are still keenly awaiting the decision. It's believed that Muto is seen by many as a less aggressive option and would be more accepted by the opposition Democratic Party of Japan. Indeed, the Democratic Party's shadow finance minister Maehara said that they will not automatically reject Muto. The Bank of Japan's minutes for the January meeting indicated that a few members were reserved about the upgrades of the Japanese economic outlook. Meanwhile, two Bank of Japan members expressed that extending the maturity of bank bond buys was an option. The Canadian dollar extended the recent decline against dollar after another round of weak economic data. Retail sales dropped sharply by 2.1% in December, much weaker than expectation of 0.3%. Ex-auto sales were also weak and dropped 0.9% versus expectation of a 0.1% rise. Consumer Price Index moderated more than expected to 0.5% year-on-year in January, while core CPI also moderated to 1% year-on-year. The New Zealand dollar was weighed down by the Reserve Bank of New Zealand Governor Wheeler's comments today, and recovery in Australian dollar New Zealand dollar helped lift the Aussie mildly elsewhere. Wheeler warned that, when the New Zealand dollar is coming under upward pressure, we want investors to know that the Kiwi is not a one-way bet. And he noted that the Reserve Bank of New Zealand is prepared to intervene to influence the Kiwi, even though, given the strength of recent capital flows, we can only attempt to smooth the peaks. He said that the G3's ultra-loose monetary policies are aimed at stimulating growth but also have significant spillover effects, and many other countries are affected as investors sought high yields. Nonetheless, Wheeler noted that limitation of intervention and a Swiss-style cap isn't practical for the Kiwi. Finance Minister English also said last week that weakening the Kiwi through intervention against large-scale speculation is like being out in the war zone with a pea shooter. The Reserve Bank of Australia minutes released in the Asian session unveiled that recent rate cuts have shown effective in boosting the economy while benign inflation might trigger further rate easing. Regarding developments in China and Japan, the minutes stated that a wide range of indicators showed that growth in the Chinese economy had stabilized, underpinned by public spending and somewhat stimulatory financial policies. There had